Welcome to the fourth analysis on Berkshire Hathaway. In this video, we'll talk about major risks of Berkshire Hathaway and some investment strategies that we can take. First, regarding the major risk factors, you already identified most risks in the comments of previous videos. We will start with the risk of equity fund, which is that the stock investing return has been going down in recent years. As we saw previously, when Buffett started out investing, he generated very high alpha in his early years. However, as the company became bigger, his alpha has gone down, and in most recent years, it's almost non-existent. So this risk is definitely true. However, as we saw during the business analysis, the stock investment return doesn't have to be so high because Berkshire has this insurance structure where it utilizes insurance float and also generates profit from underwriting. So in order to see the result of these activities, let's look at the historical performance, focusing on recent decades, especially the part when equity portfolio became bigger than $100 billion. And as we can see here, Berkshire still generated 11 to 14% return, even though the alpha from equity portfolio almost became zero. Hence, stock investing return going down has been true for a while, but going forward, it's not actually a very significant risk. Moving on to the second factor, it's still related to the first, but people are worried that Berkshire became too big, so it'll be hard to deploy capital in a profitable manner. Since we talked about the equity fund, let's look at how Berkshire can deploy capital in MSR segments. It is comprised of more than 60 companies, and as we can see here, since the 2008 financial crisis, the M&A size has become bigger. This has both pros and cons. The downside is that it's harder to come by such large targets to acquire. However, the benefits are there are also fewer players who can acquire billions, sometimes tens of billions dollars of companies. So Berkshire has less competition when acquiring these companies. Also, the subsidiary companies can also conduct bolt-on acquisitions. So it's not just Berkshire, the holding company, that has to acquire large businesses. So considering these various options, we can see that Berkshire can still continue to do M&A activities in the future. However, the biggest pie where Berkshire can deploy capital is the utilities business. Here, Berkshire can deploy capital and get 10 to 15% return at a very stable rate. And the AI boom, which is increasing the demand for power, is actually a positive factor for electric utilities. So here, Berkshire can easily deploy billions of dollars each year. And regarding this second risk, if the market becomes too worried about Berkshire's investing return and its stock price goes down, then the management can conduct stock repurchases and continue to generate return for the remaining shareholders going forward. Third risk is autonomous driving, which can make auto insurance obsolete. As we saw before, insurance float is a very significant portion of Berkshire's capital. However, instead of looking at this as a one big chunk, we can divide it into four subsegments. The green portion here, which is the largest, is the reinsurance group. This is very specialized practice where Berkshire becomes the insurance company for insurance companies around the world. And this portion is not related to auto insurance, so we don't need to worry about this becoming obsolete. The part that will be affected by autonomous driving is Geico. And as we can see here, this segment has been growing quite well, and it contributes 19% of total float for Berkshire. Although it's not yet clear that autonomous driving will definitely make auto insurance obsolete, because it's not really clear who will take responsibility if there is any accident. However, I'll just assume the worst case and say that the whole Geico business will disappear going forward. So 19% sounds pretty big impact. Nevertheless, insurance is only 20% of Berkshire's total value. So even if Geico disappears, its impact on the overall business will be only about 3 to 5%. So we can see that this third factor is not actually very serious. The fourth risk is quite serious, which is when Buffett is gone, the management risk factor will surface. This was very evident when Warren Buffett announced that he will step down as CEO in this May. The market reacted very negatively, and the Berkshire stock price fell significantly over the several months following period. So let's take a step back and see how Berkshire is managed. First is the public equities portfolio. Here, Ted and Todd, who joined Berkshire over 10 years ago, has been managing capital for more than 10 years. Although it's not clear exactly who bought the Apple shares, it was one of these two who acquired Apple shares first and also are investing in Amazon. So their investment style is well adapting to changing market environment. Also, as we saw before, the public equity portfolio does not have to generate significant alpha going forward. If it can just generate the market-like return, because of the insurance firm structure, Berkshire can benefit. So going forward, this doesn't seem like a serious concern. Next is the insurance business. This segment has been led by Ajit Jain for a while now. He joined Berkshire in 1986, so it's been almost 4 decades, and he worked with Warren Buffett in building this business. So even when Buffett is gone, we can be confident he can well manage the business going forward. And next is the MSR, which is comprised of more than 60 companies. But since the beginning, these companies are not managed by Warren Buffett directly. In fact, they're very decentralized, managed by existing family members or management teams who were there before the acquisition. So going forward, there's probably not much change going on in MSR division. Next is the utilities business, which is led by Greg Abel. We'll talk about him in next session, but he also has been managing this business for decades now. And considering that it's not a rocket science to manage utilities companies, there's probably not much management risk going forward in utilities. And the last piece that Warren Buffett has contributed significantly is the capital allocation at the holdco level. And this has to be led by Greg Abel going forward. So let's look at who he is. He was born in 1962 and joined Mid-American Energy in 1992, which was acquired by Berkshire in 1999. And about 20 years later, in 2018, he became the vice chairman of non-insurance businesses. So he has been in charge of utilities, railroad, MSR, basically all operations outside of the insurance business. And it was in 2021 when Warren Buffett confirmed that he will become the next CEO. So as we can see here, he's not a newcomer to Berkshire, and Warren Buffett and Charlie Munger had a long time to work with and also teach Greg Abel during all those years. And it's not only this, unlike most CEOs of public companies, Greg didn't get any stock options, grants, or RSUs. So basically, he had to spend almost all of his net worth to purchase stocks of Berkshire in the open market, which means his incentive is well aligned with ours. And he's not getting hundreds of millions of dollars of bonuses, so I'm confident that his interest is well aligned with mine as a Berkshire shareholder. So as we saw here, the next generation of managers are quite able and has been proven for over a decade. Of course, there are still risks going forward. That is, what will happen after 20 years? Especially Ajit Jain is already 74 years old, so we'll have to worry about his replacement in less than 10 years. So when Buffett is gone, the market can react negatively, but we can be assured that at least the next generation of managers are well proven with a long history of track records. Moving on, next is regulatory risks. These are especially related to the utilities, railroad, and insurance businesses. But the most worrisome of these are the electric utilities. As you may know already, utilities are government guaranteed monopolies where the returns are fixed but can generate satisfactory returns. However, Warren Buffett has warned in his 2024 letter that populist policies could lead to confiscatory resolutions or public power resurgence as it happened in the past. So Berkshire is actually worried about this sector, so their capital deployment has been stopped or slowed down quite significantly in recent years. However, going forward, as I mentioned, the AI boom is creating huge demand for power. And so in recent years, Berkshire actually invested in projects that apply power to data centers. And also, the fact that Trump administration is quite pro-business can help these electric utility sectors. So the regulatory risks are definitely there. However, it's not so bad that we cannot invest in Berkshire Hathaway. Similarly, all these five factors are all somewhat meaningful and partially true. However, whenever we invest in companies, there are always risk factors that we should consider, and none of these seems extremely serious. So going forward, we'll have to check on this as an investor, like at least once a year, but none of these seem to be a deal breaker. So now let's move on to how we can invest in Berkshire. And as always, I want to remind you that this is not an investment advice, and you need to make your independent decision about investing in Berkshire Hathaway. And regarding the way to invest in Berkshire, in the previous valuation video, I discussed how we can calculate the intrinsic value utilizing various methods. And based on this, we can take on the first approach, where we treat Berkshire as just a value stock. So whenever the company becomes cheap, we can buy, and if it becomes expensive, we can sell. And in the third video, I also talked about various quantitative measures to see how cheap or expensive Berkshire is. So this is the first method. And second method we can consider is comparing Berkshire with S&P 500. And as we discussed before, we can utilize various probabilities and scenario analysis to see whether investing Berkshire or S&P 500 is better depending on our assumption of market going forward. And third approach we can take is as a passive investor. S&P 500 and Berkshire has similar expected return going forward, about 9 to 12% per year. You may think that If the return is similar, why don't we just invest in S&P 500 and forget all these complications? So that brings us to the second, very important positive of investing in both, better diversification. And as we saw in our first video, there's actually very little overlap between Berkshire and S&P 500. In terms of stock portfolio, there's only about 8 to 9% overlap, and if we see the sector exposures, S&P 500 is more exposed to the sectors on the left-hand side, and Berkshire is more exposed to the right-hand side. Especially the utilities are stable compounder, but S&P 500 is not exposed to it as much as Berkshire, so we can better balance out our portfolio. And as Ray Dalio has mentioned before, if we can generate similar level of return with more diversification, the risk of the portfolio will go down. So this is why passive investors need to consider investing in both S&P 500 and Berkshire. And this brings us to the third positive, which is the extreme valuation of S&P 500 at the moment. As we can see here, the market index was only higher during 1999 IT bubble period. And if the market returns to the historical median, then the market overall can fall over 50%. And as we can see, Berkshire is somewhat overvalued at the moment as well, but is not as extreme as S&P 500. So let's see how investing in both S&P and Berkshire has reduced risk over the past. Here we can see if we had invested in both S&P and Berkshire at 50-50, the expected return is quite stable, but the overall volatility of the portfolio decreased. So if we invest in half and half, we can get the highest Sharpe ratio. This is another study, and we can also see that investing about half and half generates similar level of return, but lower volatility. So the Sharpe ratio is actually higher and beta goes down. Some people may consider going all in Berkshire and just not bother with S&P 500, which is very expensive at the moment. However, the market could still go higher because of the AI boom. And a large negative for Berkshire is that it lacks exposure to the AI sector. So we can supplement this by investing 10 to 30% of our portfolio into more AI companies or related indexes such as QQQ. Now let's look at how active investors can utilize Berkshire. First, we can recognize that Berkshire is a high-quality, stable compounder because of its structure. And of course, if the market goes up much higher because of the AI boom, the 10% compounding may look quite boring. However, if the market correction happens, then 10% return, especially because Berkshire can take advantage of such market panic with the billions of dollars that it has on its balance sheet, Berkshire Hathaway or similar business structure can be a good option. So, if you're an active investor, you may want to find cloners, businesses that are similar to Berkshire. And we can find this in United States as well as internationally. Some of these companies have insurance structure, but some of them have holding co structure or private equity funds. And these companies are well diversified and has similar structure as Berkshire but much smaller. So going forward, they're actually better positioned to generate 15% compounding return for decades to come. These are not easy to come by, but I was able to find out about 10 of these companies, both in the US and abroad. I'm already investing in some of these companies, so if you want to see this model portfolio, you can check out the link below or leave a comment if you're interested in these businesses. I'll try to cover some of these on YouTube as well. So that sums up my series on Berkshire Hathaway. Thank you for watching. If you want to see analysis similar to Berkshire, please click the like button below and subscribe to the channel.